Just as a brief introduction, Tim is the managing director of the investment strategy for S&P Dow Jones Indices, and has garnered years of experience in index-based investing, especially when it comes to making indexes. Just to give the audience a brief idea, us as a mutual fund company, we don't do a lot of analytics on how an index is constructed and what should go in, what should go out. That is all decided by the index company. So in India, I'm sure a lot of you would have heard of Nifty. When it comes to international indexes, I think S&P Dow Jones is probably one of the biggest and most popular ones out there. We also have an S&P 500 fund, which is extremely popular with all our investors. So that's basically why index providers are equally, if not more important, to our investor base than us as an asset manager. So today, Tim will be helping us understand how one can go international with I think passive funds, the ease of use of international investing, and what sort of innovation is the team is at S&P Dow Jones are working on in terms of future products. So thank you so much. Over to you, Tim. Thank you.
Thank you very much for that warm introduction, Pratik, and thank you to the organisers for inviting me to participate. I'm delighted to be joining you, and a very good afternoon, evening to those who've joined around the world, but of course, especially in India. So now comes what I hope will be the only difficult part of the presentation, when I try and share my screen and we see whether or not that works. So fingers crossed, everyone. Are we in? Excellent. I hope you can all now see this. So international investing the passive way, and so I'll be talking for about 20 minutes on really the core ideas and benefits of international investing in a passive framework. And I really want to strip it back down to the basics, and if I don't answer these questions successfully in the next 20 minutes or so, please be reassured that there will be time for Q&A. But when you think of the notion of investing abroad in the equity markets, you've got some really basic questions that you're going to start with. So first of all, what? The international equity markets are a big and wide world. So which markets should you invest in? What are the thoughts that might be in your mind as you think about which exposures are going to be complementary? Why? What is the point? What are you hoping to achieve? And we'll talk a very little bit about why that might be different for investors in India than it is for investors elsewhere. How? Should you be looking for an active and dynamic allocation, or as the title of my talk suggests, is it perhaps very useful to think about a passive core building block to international diversification as perhaps the first step, or as perhaps the last and the most strategic step? And finally, when? Should you be timing the market, or when is international diversification going to be a help, and when is it going to be a hindrance? And I will talk a little bit about all of these questions, but one of them I can at least give you a broad idea before we even start. So when? And note, the key here is that word diversification. The idea of a diversified portfolio, or the benefit of a diversified portfolio, is that you will have a broad range of different performing assets, some of whom will do well some of the time. And what you hope is that when parts of your portfolio are doing very badly, other parts of your portfolio will be leading up and helping manage those drawdowns. So if you have a so-called diversified portfolio and everything in your portfolio is doing really well, you may not be that diversified. The point about diversification is essentially you can sort of flip it on your head. Yeah, there's always going to be something doing well, or you hope there'll be always be doing something well. But as a natural consequence, there's always going to be a part of your portfolio that isn't doing so well. I.e., if there isn't a little bit of pain somewhere in your portfolio, you're probably not sufficiently diversified. The when of diversification, at least in sort of principle, is always. So with those motivating ideas finished, we'll go on to, I think, and we do need to address this question because the Indian economy has shown over the past 20, 30 years even, one of the fastest growth rates of any global market. I personally am very sympathetic to the idea of backing India to grow and adopt its proper place on the world stage. And this is and much of what I will show you today is based on a research paper that we published last year. I'll give you another reference to that at the end. A lot of the data will be up to that point last year when we published that paper. As of June of last year, you can see here, so this is in red, the performance of the S&P India BMI, a broad-based equity index for the Indian market, compared to the roughly 50 different countries that are also represented in our global BMI. The performance here and just about everywhere in my presentation will be reported in Indian rupees. And just looking at this chart, you might well ask, why would I want to diversify? India is the best performing country over the last 20 odd years. And there's good reason to suppose that India might be one of the best performing countries in the near term future. So what's the point? Why would anyone consider diversification? Well, and here I'm going to switch to the Sensex, the S&P BSE Sensex, to give it its full name. The reason I do that is because it is one of the oldest major benchmarks in the world. So the Sensex has a really rich history that we can use for study and examination. And here what I'm showing you is, although you have that fantastic long-term performance, along the way, there have been plenty of difficult and challenging times. Drawdowns of 30, 40, even 50% occurring on a semi-regular basis. And as investors, these are the hardest times. With hindsight, we often know that those large drawdowns are exactly the time when you shouldn't be leaving the market. And yet, as investors, it's very difficult to stay the course. And one of the most powerful things that a financial intermediary, wealth manager, for example, can do is to help clients to stay the course in those times of drawdown. And the most helpful thing to help people stay the course is quite literally to limit those drawdowns. And so you really want parts of the portfolio to zig as the core zags, meaning that you can preserve your capital better in those times of hardship. Now, how does this relate to international equities? Well, just to give you, a big picture idea, here's looking at the Sensex, again, which has one of the longest histories, versus the S&P 500, which has a live track record that stretches back to 1957. And on the left-hand side of what you can see, I wanted to just kind of illustrate these periods when one is leading or the other is leading. And you have these sort of long 6-7 year periods, a couple of short periods where one market is doing much better than the other. On the right-hand side, I just calculated, this shows you a ratio of the two indices. So when on the right-hand side, when that chart is going up, that means the Sensex is beating the 500. And when the chart is going down, it means the 500 is beating the Sensex. And what you can see is a strong a sense of different returns. Sometimes one does well, sometimes the other does well. So this is very interesting from a diversification perspective. It suggests that there is a strong value in owning the pair of those indices over the market cycle. So in order to sort of take that concept and show you how that might have worked in theory historically, and again, we do have this long history for the Sensex and the S&P 500 that we can use. So this is just looking at a hypothetical 50-50 split between the S&P 500 and the BSE Sensex, again, all in Indian rupees, and looking at a quarterly rebalance back to 50-50. And you can see the power of that diversification coming through in returns. Now, and I should stress, this is unusual. This is not something you often get. This is a really complementary pair. And what's unusual is the combination portfolio actually outperformed, did better than either one of the individual pieces. Now, how's that happened? In part, it's because of that rebalancing, but it's the combination of that rebalancing and the fact that the combination of the two meant you preserved more capital in those drawdowns, which gave you a higher base from which to participate in the subsequent growth. Now, of course, diversification can help return. The real fundamental piece is about managing risk. Now, there's lots of different ways we can measure risk. Just the most common one is just measuring the volatility. And here you can see in yellow the trailing 5-year volatility of the Sensex. In light blue, the S&P 500, and in that dotted line, the combination portfolio. And you can really see how even a 50-50 combination, because of those complementary diversification effects, has dragged down the volatility of the Sensex almost all the way down to where the very large cap S&P 500 is based. The power of portfolio diversification is one of the major tools available to portfolio management. And I don't want to spend too much time on this, but I just wanted to give you an idea. There's obviously a broader context. You have the Sensex, the S&P 500, you might have gold, you might have fixed income, and adding US equities can be a real power tool to give you a wider and broader range of risk return potential. Now, we will come back to the S&P 500, but I wanted to just to give you one other perspective. So this is kind of a country-based, think about the US. When you're thinking about diversification, one of the things you want is complementary portfolios, different portfolios. One great way to look at this is from a sectoral perspective. So here you have the sector weight of the Sensex, which is pretty representative of the Indian equity market, the S&P 500, and the global BMI. And what I've done is I've actually ordered this table to show you where the big differences are. And on the right-hand side, you have the difference between the global or US markets versus the Indian markets. And I wanted to highlight a few things. First of all, the Indian markets are heavy or somewhat heavier in the energy, financials, and staples sector down the bottom. And some of the pieces that they're lacking in terms of what's the global opportunity set, healthcare, industrials, and consumer discretionary. So that international allocation can actually give you access to the returns of economic segments that are underrepresented in India, healthcare in particular being one that has obviously been in the news a lot over the last year. I also use this slide just to illustrate that actually the S&P 500 itself can be an efficient tool to access those global sectors. As one of the other speakers mentioned, the US equity market has some really global names in it, like in healthcare, for example, Pfizer, Moderna. These are global names, not so much as US names. And the sectoral perspective can be really powerful because of how differently sectors behave. So this is picking, one of the evil things that presenters can do is pick their time period carefully. I showed you at the beginning a 20-year period where India did very well. In this one, I've picked a 10-year period where India didn't do quite so well, certainly compared to global sectors. And notice what India is hewing close to in here: financials, energy, materials. Those were the sectors that India had large representations in. The ones that it was missing, things like discretionary, healthcare in particular, these were the ones that did very well over that 10-year period. It's giving you another perspective on how the drivers of returns could be complementary in global markets versus the Indian markets. All right, so that is a very short summary of the notion and idea of why and how the diversification can help and what can make it work. Now let's talk about the next question. This is the passive enclave. So if you're going to invest internationally, should you try and pick stocks? Well, you certainly can try, but let me just first tell you that picking outperforming stocks in most markets, but in the US equity market especially, is especially hard, or it certainly has been hard. And that's not just because it's a very efficient market, it's also because of the structure of the equity markets. So in order to produce this particular chart, what we did was we took every stock that was ever a member of the S&P 500 over a 20-year period, and we looked at those returns of those stocks, and here's the distribution. So going left to right on the chart, you've got around between 10 and 15% of stocks that were members of the S&P 500, and in 20 years went down from 50 to 100%. Right? It can't go down more than 100%, but they can go up a lot more than 100%. And what you see is this long right tail with a couple of stocks, between 5 and 10% of the sample that delivered a more than 1,000% return, more than 10x. Now, because of this right skew, you have a small selection of stocks that historically have actually driven up the index return. Notice where the median was. 50% of stocks were below that median. In fact, over 2/3 of stocks were below the average. The index captures a share in all the returns, including those absolute heroes on the right-hand tail. And because of those, it's very hard to pick outperforming stocks. And this is especially true of the US equity markets over the past 20 years or so. I actually anticipate this will be true of stocks in the future because of what I mentioned at first. They can go down up to 100%, but there's no limit to the upside. So there's the theory. What about the empirical results? Well, for 20 years now, S&P has been publishing what we call our SPIVA reports, S&P Index versus Active. And what they do, we do this for India as well, is we look per region, US, UK, India, etc. And we'll look at actively managed funds, and we'll look at the percentage of those that are beating an appropriate S&P benchmark. So for example, in the US, it's the S&P 500. In India, it's the S&P BSE 100 for large cap funds. And what you see, so these are all the 10-year figures. The most recent ones are for the 10 years that ended in the summer of 2021. And you see around the world, generally speaking, a majority of actively managed funds underperformed, but I highlight in the US, you're looking at about 83% over the last 10 years. That's not an unusual figure. So empirically and theoretically, there's a very good argument for thinking of a passive approach to global diversification. And in the US markets in particular, as I said, it has been very hard to beat. So this is looking at the 1-year figures, year on year, 2001, 2002, and so on. What percentage of US-based large cap active funds managed to beat the S&P 500? Overall, most years, you're looking at a majority of funds underperforming. But notice since 2009, there hasn't been a single year when the average fund, when the median fund has outperformed. And I don't have an awful lot of time left, but I do want to just talk a little bit about really why that's going on. We talked about the skew, but there's also market structures here. So S&P 500 launched in 1957. In the mid-60s, you have some statistics here that shows about the professionalization of that market compared to roughly where they are today. So, you're going from 3 million shares trading a day on the NYSE, New York Stock Exchange, to around 1.5 billion shares. And that's statistically 2018. How many securities analysts are there? People with the job of identifying mispricings. That's kind of it's a newer career. There are up to 300 per broker, and there's a lot of brokers in the US today. There were very few back in the 1960s. The CFA, Chartered Financial Analysts, it was introduced in the early 70s. There were none in the when the S&P 500 launched. There are something like 150,000 CFAs today, another 250,000 taking exams. And then, very quickly to summarize, Bloomberg terminals have gone from 0 to over 300,000. The notion of a professional investor, there was only about 5,000, something like that, professional investors in the 1960s. I believe there is over 1 million people worldwide engaged in professional investing. Hedge funds, smartest money in the room, gone from very, very small proportion of the markets to around 4 trillion. ETFs, now this is really important. As investors turn to passive, what's been happening is, look, if I want to be above average, I need someone else to be below average. I need a net supply of my outperformance. And what's been happening in India and even longer in the US is those undiversified amateurs, those investors who maybe aren't smarter than the hedge funds, who've been a source of outperformance to those hedge funds, they've been disappointed with their performance, and many of them have been moving to index funds, and they've been getting the average, and they have not been supplying alpha to those who want to beat the average. Now, the US market has professionalized an incredible amount over the last 50 years or so, 60 years. But what is fascinating is to see this professionalization extend and develop in other markets around the world. I think the Indian market is one in particular, which is going through a rapid pace of professionalization. And I think some of the themes and challenges about performance that we see today in the US are being exported around the world as efficiency improves and the market gets harder and harder to beat. All right, so that kind of covers some of the ideas of why you might want to be passive. What difference does this all make to a portfolio? And this, again, is coming from that research we published last year. Just wanted to give you an idea of context. I hope you can see the right-hand side of this. If you can't, maybe move the video. But just to put it in context, right? So using our India SPIVA data, what's the difference between a top quartile Indian fund, active equity fund, and a bottom quartile over the last 10 years? 3% per annum. Right, so that's the difference. That's the value of picking a good fund, if you like, over a bad fund. 3% per annum. What's the difference? On average, based on a sort of standard deviation between gold, bonds, equities, or US equities overall. So thinking about that overall asset allocation, about 10%. Much more important decision. What about picking, say, healthcare versus information technology? I mentioned sector dispersion is very high. It makes a big difference. And here you see that on average, around 20% in return difference between information technology and sectors. That makes that an important decision. But right at the bottom, year on year, over the past 10 years, what was the difference in returns between the S&P 500 and the Sensex? An average of 26%. That is the power of that decision. Even a small allocation can make a really, really big difference. And I think that's one of the drivers behind the adoption that we've seen of passive, efficient ways to access international equities that has become such a strong theme within the Indian markets. I know I'm short on time. I just want to say just very shortly why the S&P 500? Why not just any other index? And I don't, maybe we get to this on the Q&A, but just very briefly, Indian investors who are looking at an S&P 500 exposure in India are leveraging and participating in a pricing efficiency based on a global range of trading products. The S&P 500 is watched by professional investors, watched like a hawk, traded by futures and options and ETF investors all around the world. There's a whole ecosystem policing that index level and helping liquidity for, say, an Indian fund or an Indian ETF or a Japan and so on. They're all participating in a global trading ecosystem that can help pricing and make bid-offer spreads more efficient for that S&P 500 index in particular versus any other. So I just wanted to highlight that on the left. You just have a comparison between US ETFs. The average bid-offer spreads are lower on S&P 500 products. On the right, it's just I'm not going to spend time on it, just an idea to give all that ecosystem, options, futures, leveraged ETFs, and so on. There's a really wide pool. All right, so I promise not to take too long. Here is what I hope I might have convinced you or persuaded you of. Number one, look, the Indian domestic markets have been fantastic and may well continue to be so. But an allocation to international equities can offer diversification benefits that can help you stay the course when the Indian markets go through the periods of not doing so well. Liquid, widely known and efficient indices like the S&P 500 can be used to capture a significant proportion of that opportunity of diversification without the need to pay a high fee or try to outperform the market. And these are just some examples of the way that passive investments, index-based tools offer toolkits for quite sophisticated portfolio construction. And this empowers investors to really focus on the most important decisions. So if you found all this interesting, and we will get to the Q&A, just a very, very short plug. If you'd like to dig into the weeds on this, as I say, we published quite a meaty paper last year called From Zero to Hero, the Indian case for global equity diversification. Why from zero to hero? Because 5-6 years ago, international home bias was close to 100%, but that's changing. And one of the fastest growing areas is in this index-based approach to international diversification. If you want to dig into this more, I'd encourage you to check out the paper. And of course, there's lots more data, analysis, and commentary, as well as our SPIVA reports available on our website, which is spdji.com. So with that, I'm slightly over time, but I hope you enjoyed it. And now I see the floor back to our host, Pratik, and hopefully we'll have some Q&A.
Sorry. So great. Thank you, Tim, for your insights. That was extremely informative, and I think we've all been, I think, reiterating the fact that the true nature of international investing is actually diversification. I think, as you said, and that remains to be one of a lot of our investors that we have in our funds. The reasons to why they would, I think, put a part of their portfolio outside. So thank you so much, Tim, for the presentation. So now we'll just go on to a quick Q&A round. We have a bunch of questions on a YouTube channel. I think the first question comes for you in terms of from a global perspective. Since you see things from a very sort of global perspective, what are the most popular strategies that you are seeing right now? Not in terms of what's the largest, but especially in the current times, what are you looking at it, or what are you seeing as an index provider? Some of the largest or most popular strategies for investors today.
Yeah. So look, if you look around the world, then I'll give you a sort of boring answer first, and then a slightly more interesting answer afterwards. Okay. So what are the most popular things? Where are the majority of the investments come over time? They really are in these core building blocks, right? The countries, sectors, things like the S&P 500, where it's a bulk allocation to a whole market available at very low cost. These are by far the most popular overall, which I think is actually no surprise, right? Then more interestingly, where are we seeing new or developing interest? And where's the innovation, and which innovation are investors responding to most positively? And there, I'd say, if you look globally, one of the pieces of the puzzle that is just going through an absolute revolution in terms of investor interest is, if I say ESG investing, some people might not know what that means, but investing based on values as opposed to investing based on value. So looking at considerations like the environment, carbon emissions, or social goals like alleviating poverty, especially in Europe, but around the world. This is an absolute revolution with so much demand, so much interest, so much innovation. And speaking of innovation, that's perhaps just to add one or two additional thoughts. I think innovation is also something that there's a lot of interest in. The notion, particularly in markets where there's maybe not that bank of innovative companies that are part of the core of the equity market, looking for the next generation of what in 10 years is going to be a major sector, and we don't know. It could be satellites, it could be any number of things, it could be decentralized finance. We don't know what it is, but gaining access to really innovative companies that are laying the grounds for the important segments of the economy in the future is something I think there's a lot of interest in globally, and especially in those markets where they maybe don't have a strong representation domestically from innovative firms. So that's a slightly longer answer than you wanted, but to shorten it, bulk beta, is really popular, always will be. A lot of innovation in ESG, and that notion of innovative companies also something that I notice is a global trend of interest.
Got it. Great. Just one last question before we wrap up. Very good question, actually. It says that, and this could be relevant from sort of a multi-country analysis. Inefficient market passive funds are better suited for efficient markets, but not for inefficient markets. What is your take on that?
So I think there is. Let me put it this way: a skilled active manager means something different in more efficient markets, right? So the question is, how difficult is it to beat the benchmark? And it typically and theoretically, it's easier to beat the benchmark in a more inefficient market. The challenge is that's not what our data says. What our data shows you is that actually markets like emerging markets or more volatile or more risky or less efficient markets, although it's certainly true that there's more opportunity for outperformance. Trading costs are normally higher. Information is typically harder to get hold of. And the realization of skill is often much harder, and fees are much higher. So while sort of theoretically it's absolutely true, and I think the case is stronger for markets like the S&P 500, one challenge is that our SPIVA data suggests that actually it's not exactly what you expect, and actually outperformance in these inefficient markets is almost as hard. Certainly, it's not true that it's easy to beat the market.
Great. Thank you, Tim, for your time and for the valuable insights. Hope to have you.
Thank you for having me.
Hope to have you again. Ladies and gentlemen, that was Mr. Tim Edwards from S&P Dow Jones. Thank you for your time, and looking forward to more events. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.